Nippon Steel's a shining example of much that's right and wrong with corporate Japan. Leading Japanese metal bashers embrace the reforms of Prime Minister Shinzo Abe. It's qualified for the JPX 400 index of the country's better-run companies, and it's seen its shares tumble anyway. There's a strong case to be made that Japanese companies are improving in vital ways. Nippon Steel appointed its first 2 independent directors in June last year. Now, you might say by global standards and certainly by British or American standards that's terrible. But by Japanese standards, having 2 independent directors is a major step forward. It's also set out an ambitious, again for Japan, goal for its return on equity, and it's even sold some of the shares it has as cross-holdings in other companies, although it doesn't have a policy to sell off all the rest. Since the start of the year, its shares have lost 1/5 of their value, even as the broader Topics index and the Nikkei have risen. You can see Topics here in red and Nippon Steel here coming down sharply in blue. Now, as Hugh Sloan of hedge fund Sloan Robinson puts it, it's so depressing. Nothing offsets the cycle. Now, this isn't just a story about Nippon Steel, but while we're on the company, which is ambitious enough to want to be the world's best steel maker, it's worth noting that improving corporate governance really does work to some extent. Shares may be worth less now than they were in 1981, but they've outperformed global steel makers, which I can add on here in green at the bottom. They've outperformed them by 1/4 since the start of 2012, once adjusted for the weaker yen. Now, some of that outperformance is clearly down to the hope of Abenomics in late 2012. You can see the very sharp run-up there in the blue line for Nippon Steel, and more broadly carried on a bit longer for the Topics as a whole. But a lot comes down to a shift to treat shareholders better. The run-up that we had last year, you can see, where are we, this one here, was at the point at which the new non-executives were appointed. Now, Nippon Steel, of course, is just one of many Japanese companies changing their focus, with share buybacks becoming popular at many of them to reduce cash piles and help to boost return on equity. The problem is that Japan's very heavily exposed to the economic cycle and to the troubles of its larger neighbour China, which of course has excess capacity in lots and lots of products, including steel. About 3/4 of Japanese companies by value are in cyclical sectors which move with the economy. That's higher than the rest of the world, leaving Japan more exposed. Still worse is that the single biggest sector by value in Japan is consumer discretionary. Businesses like car makers, retailers and electronics producers, which make up almost 1/4 of market capitalisation. Not only does this hurt when investors worldwide are downgrading their expectations of economic expansion, but in Japan, that's the red line on here, it's hurt particularly badly as the economy fails to respond to the Abenomics prescription of easy money and tax rises, and another recession now looks possible. On here I've put the consumer discretionary sector in the US as well, so you can see how much better that fared during the August plummet. The response, this broadly speaking, of course, being the fall as China devalued its currency. And these are both in the same currency, so we've taken out the effect of movements in the yen against the dollar. Now, there is hope for Japan, particularly if the Trans-Pacific Partnership trade deal's implemented as agreed. But pay and inflation haven't gone up so far very much in response to the unprecedentedly easy money that the Bank of Japan's been printing. Corporate reform provides a bright spot in the failure so far of Abenomics to turn Japan round, and there is of course good reason to think that better run companies will produce better returns in the long term. But for the moment, the economic cycle matters far more to whether investors make or lose money in Japanese stocks than any amount of corporate governance reform.